If you invested at the right time in a hype stock, you could have grown like $1,000 to $8,000. But then again, you could have grown to $212,000. What a big difference. We got a lot to unpack in today's video. And in this video, we're going to talk about the YouTube hype stocks, you know, the ones that we often talk about here on YouTube, and we're going to compare them to some growth ETFs, and we're going to compare them head to head. I asked you, the audience, earlier today, in fact, what stock you think is most hyped here on YouTube. Let's go take a look at the results. Here we have AMC at 51% of 254 total votes, and this was only posted 4 hours ago. GameStop at 28%, Tattooed Chef at 3%, Palantir at 8%, and then I have 2 comments here, even though 10% of y'all hit other, but you didn't comment. So a shout out to these 2 people that actually commented, Amazon and TROW, T-Row price. So here's what we're gonna do, because I know you guys like when I pull out the Excel spreadsheets. Right here, we have the YouTube hype portfolio and 5 different comparable growth ETFs that I'll share with you in today's video that it'll be interesting to see what actually happens when you compare these to that. 5 against 5, who's gonna win? Now, what we're gonna do, because typically, and studies have actually shown this, that the retail investors are often late to the party. And what that actually means is that you and I, the everyday retail investor that goes out, you know, we have some money and we decide, oh, I'm gonna invest it in some type of stock. Which one should I invest in? So all of a sudden you're hearing about something going on. Maybe it's AMC is all of a sudden surging back up and you're like, oh, that one sounds like that could be an opportunity. Or maybe, hey, GameStop, they're all of a sudden shooting to the moon. That could be my ticket to the $1 million status. So you decide, you know what, I'm gonna throw some money into it and see what happens. Well, maybe it goes up and then you start throwing more and more money, but the problem is you're a little bit late to the party, because then all of a sudden the darn thing turns on us and it crashes down. If you haven't been there before, I have. And I know some of you have, and it's painful. So if we're always late to the party, that's how we're gonna judge today's Excel spreadsheet. Now, late to the party would have been you invested in these type of things right around November 2021. November 21, everything was going absolutely mad. All the stocks, all the crypto was shooting up to the moon. Everybody was greedy, everybody was happy, everybody was drunk and excited. And so that's when everybody decided, I'm gonna go ahead and buy in because everybody's talking about it. Little did they know, late to the party. So what we'll do is we're gonna compare first AMC, GameStop, and TTCF. And what we'll do is we'll come over here to the backtest portfolio that we typically use. What I'm gonna do is say November 2021 to today, which is, you know, not December 2022, but up until year to date in 22. Let's say we had $1,000 and we decided to invest $1,000 into the top 3, AMC, GameStop, and Tattooed Chef. So AMC right here at the top in asset number 1, GameStop is GME, and then we're gonna do TTCF. And what we're gonna do is we're gonna track this in the Excel spreadsheet and we're gonna see what this does compared to the growth ETFs. And by the way, I'm not blowing smoke up your you know what. What I'm doing is I'm actually sharing the fact that in 2022, yeah, the market sucks. I mean, we're down significantly. The entire S&P 500, the Dow Jones is down thanks to the pain and agony of this year. So none of these things are necessarily gonna look sexy and green and positive, but I'm showing you the real facts, and that's what you need to know, especially if you're just getting started off with investing. So here they are, AMC, GameStop, Tattooed Chef. Let's go ahead and analyze these portfolios. And then between November 21, when the hype's going on, to today, here's what you're ended up with. Your $1,000 balance in AMC dropped to only $433. You got GameStop down to $682 and TTCF at $445. Look at the return percentages on that. 56% down, 31% down, and 55% down. 31% on GameStop. So I guess shout out to them because they did not drop as much as the other 2. So all I did is I plugged in those numbers right here to the Excel hype portfolio and showing our loss and our total amount. So same thing, we're gonna do the same exact thing, only gonna type in Palantir right here, T-Row right here. And just because somebody commented Amazon, I'll give you a bonus one, and we're gonna plug in Amazon. You know, according to this great subscriber right here, they said Amazon was one of the most hyped stocks on YouTube, so that's what we'll put on for this particular portfolio analysis. Let's analyze and see what we got. So here we are, and we have Palantir dropping to $400, a 60%. I think that one is the top bad dog in our hype portfolio. Then you got T-Row dropping to $569, down 43%, and Amazon dropping only 19%. So Amazon's looking a little bit better than the other 2. Let me plug this information in. Now, what I'm gonna do, I'm gonna throw in a little bit of a bonus here as well, is we're gonna also look at not just if you bought in on the hype, but let's say you were actually playing the game before the actual hype started. Let's say you were like, you know what, I'm gonna throw in some money into these things before even anybody really knew about them or anybody even talked about them. So a little bit later in this video, we're gonna see, are these negatives actually extremely positive, especially compared to the growth ETF portfolio? 5 ETFs. Let's get right to them. And what we're doing here, because you and I, right, if we're interested in a hype portfolio, we're interested in massive, massive growth. Now, of course, the growth is going to be dependent on who's actually more patient. You have the people that want money overnight, and then you have people that are willing to continuously invest, dollar cost average, be patient, don't worry about the drops, and just kind of hang out and relax and enjoy life. Let's see what happens with the growth ETF portfolio over the same period of time. Remember, it's probably all going to be negative because this year absolutely sucks, especially coming off of the high of November 2021. Very first ETF on the books is right here, and this is what we talked about the other day, QQQ. This tracks the NASDAQ 100, top 100 companies on the NASDAQ exchange. One important thing to know about ETFs, if you're not familiar with ETFs, is the fact that they often cleanse themselves if they're passive. And cleansing means that if you fall out as a company out of that top 100 in the NASDAQ, you don't get invested in via QQQ. It only invests in the top 100. So right now, Apple is actually at the top and followed by a few others. But let's say Apple all of a sudden dies and becomes not a top 100. QQQ will naturally reduce its holdings and buy into the next one. And you don't have to worry about it because you own the basket of stocks thanks to the ETF. But picture this, if you only have AMC and AMC tanks, there's no self-cleansing. You're absolutely and utterly screwed. With QQQ, let's say it holds AMC, AMC drops the ball. It sucks, but it's not the end of the world. You have other stocks that make up that ETF. So we're gonna do the three-peat too. So we've got QQQ, VGT, which is Vanguard's technology fund, and we have XLK. This is the State Street SPDR, also high growth fund. These are only growth ETFs that we're talking about in this video today. Let's compare these three cats and see how they go. Same time period as our meme stocks, let me plug it in. Now again, I expect these to be negative as I analyze the portfolio. Let's see what we got here. So we have drops on all of them as expected, but not as painful. You're at $1,000 from November 21 to now is $817 on QQQ, $853 and $893. Now remember, don't just think that the stock market is a scam. This is a terrible year for stocks. But if you look and zoom out for a second, which we'll do in just a second, you're going to realize how important, and back to that $230,000 that you could potentially earn, how sexy this could potentially be. I use sexy in an investment video. All right, there we go. We got it all updated on the Excel document. Let's look at the last two. We have SCHD. This is Schwab's growth fund, followed up by the final one, which is SPYG. This is actually S&P 500 growth fund, specifically focused on the growth within the S&P 500. Let's see what would have happened with these two cats. All right, same deal, same time period. $1,000 into the Schwab fund goes down to $812. 18% return, negative 18% return, and then the Spider S&P 500 growth drops to 844, 15.59% return. All right, so here we go. We got the hype portfolio totaling $2,529. Now keep in mind, you invested $5,000 over the course of these 5 stocks. Down here, $5,000 invested, you have $4,219. So these boring growth ETFs would have lost money, but not as much as your hype stocks. But let me flip this up on the head because, looking at this and looking at all these sad red numbers makes me a little bit sad. Let's flip this on its head. Instead of just investing $1,000 during the hype, let's say you got in on this very, very early. In fact, 10 years ago. We're going to compare the last 10 years from 2012 to 2022 and see how these things pan out. You're only going to drop $1,000 and you're not going to dollar cost average. You're only going to see what happens to your $1,000 after 10 years. This one's going to be a little bit interesting. So between 2012 and 2022, we have our $1,000 and we're going to do QQQ, VGT, and XLK. We're going to do the growth ETFs first. Let's hit Analyze Portfolio, and here's the results of the last 10 years. Our QQQ has grown to $6,244, and then the Vanguard ETF to $6,782, and the last one, which is the Spider, $6,638. Positive growth, that's a great thing. Now you might say, well, 10 years is a very, very long time to grow $1,000 into $6,000, but did you do it? You probably didn't, because 10 years ago you could have done this. Do you have 6,000 extra bucks? All right, now let's look at the Schwab and Spider account and see what happens. Not as much growth on these two, in fact, but let's take a look and plug them in just so we have those numbers. And now what you have is your $5,000 has grown to $29,248, showing you a positive return. And look at that difference. Having that scope, having that time in the market really does help, compared to timing the market. Now let's look at our hype portfolio and see what would have happened. Now, some of these companies haven't been around for 10 years. So we're going to do it from the point that they launched until today, just to give the most accurate information that we can. And let's look at AMC first. This is looking from 2014 all the way until today. You put in $1,000 and look what you got back, 33 bucks. Even despite this huge, insane spike where you went up to $3,829 during the short squeeze in June of 2021, you still didn't make as much money as you would have with the other ETFs. Interesting. Let's look at GameStop. Well, GameStop paints a little bit of a different picture. Check it out. Your $1,000 has grown to $8,392. That is a return of 22.26%. And of course, you could have been all the way up here to $20,000 if you would have sold at the exact precise time. Let's be realistic though. A lot of times we don't. We get so excited and we're like, oh, it's just going to keep going up. Everything's great. Everything's amazing. And then you turn around the next month and it's down to 6,276 and you're like, damn, I thought it was going to keep going up. So let's be realistic. But anyway, you did get a 22% return. Not bad at all. Now, Tattooed Chef is a hype stock that is only launched in like January, I believe, or December. You can see it starts here in 2020, does not have a full 10 years, but your $1,000 has not grown at all. It's dropped all the way down to 276 bucks. That is a negative return of 55.68%. Palantir has the same timeline as Tattooed Chef, starting right here in January 2021. And you can see your $1,000 grown or dropped actually to 439 bucks, and that's a loss of 40%. Now, of course, a lot of people might say, well, you got to hold on longer then, because those two, compared to AMC and GameStop, which have been around a lot longer, what would happen if you were to hold them a little bit longer? What if we look at this in 2033? Well, I'll tell you what, I'll do a video on 2033 and we'll see how they are compared to our growth ETFs. Last but not least is actually TROW. For some reason it says Tesla. I don't know why. TROW is what we're actually analyzing because that's what we did earlier. So TROW up here at the top, we're gonna do TROW. And this one has a pretty good trajectory and it's looking pretty good as well. Your $1,000 growing to $3,012, which is a 10.98% return. So if you invested the same amount of money, the $5,000 into the hype stock and the $5,000 into the growth portfolio, here's what we're looking at. Your $5,000 going to a nice, incredible $13,000 with the hype portfolio, but the growth ETF portfolio beating that at $29,248. The only one that really beats this, if you really look at these two, is GameStop. So GameStop growing significantly at a 22% return thanks to its incredible short squeeze that really kind of maintained. Question would be, why is it maintaining? Well, it could be because people are holding on for dear life. And when people are holding the stock, they refuse to sell it. This could be your opportunity to cash in on some profits, not financial advice to buy, hold, or sell anything. Just kind of a simulation here. And that's what we do here on the channel. We simulate things. We don't give actual financial advice. But if you would sell and cash those profits, could you potentially grow it more in these ETFs? Because one thing we're not doing is we're not dollar cost averaging. That will change this game completely. If you would have taken something like QQQ or VGT, for example, right down here at the bottom, and not only did you put your $1,000 in and grew up to $6,244, but let's say you decided, I'm going to invest $500 every single month here on out into both of these funds. What would it look like 10 years later? So we'll have QQQ, VGT, and XLK as three examples here. So look what happens. What a big difference here. Your $1,000 with your dollar cost averaging grows to over six figures, 187, 212, 212. That is a return of 65, 63%. So what a big difference here. If we're looking back here, your $1,000 and that's all you invest in that same time horizon gets you only 18%, 19%, and grows only to 6,000. But if you throw in an extra $500 a month, you get a higher return percentage, and that money grows significantly as a result of you buying the highs and buying the lows. Because here's the beautiful thing about dollar cost averaging. As that price comes down, you're buying $500. As that price goes up, you're buying $500. So you're buying the wins and the losses, and at the overall time horizon, you end up actually calculating potentially more of a return. Now that assumes that everything we looked at in today's video, that past performance would indicate future performance, and it quite often never does, which is why you got to be very careful when you do your investments. So whether you like the hype stocks or you like the more conservative passive ETFs, here's an example for you so you can do the right thing. Which one do you prefer? Comment down below and let me know. Check out this video next. We'll see you on the next video.